This is the Future of Finance. Hi, everyone. Welcome to the Future of Finance podcast. I'm George Dyer, and today I'm joined by Marina Severinovsky, who is the head of sustainability for the Americas at Schroders. And Schroders, as we talk about, is a very large investment firm based in the UK with about $1 trillion in assets under management, both in public and private markets, mostly public. I think she said about 900 billion in public markets and 100 billion in private markets, if I remember correctly. But we talk about a variety of research that Marina and the Schroders team have done recently, including identifying 8 key themes for sustainable investing in 2025, a report that they did with Oxford University, looking at impact investing as a source of alpha or outsized financial returns. That one focused on public equities markets, and also some research around decarbonization in private markets. So it's always great to get a sense of what these very large asset managers are doing on sustainable investing, especially those in Europe and the UK, as there's a lot for investors here in the US to learn on that. So I hope you enjoy this one. Please let us know what you think by leaving a comment or a review, or reach out on LinkedIn. As always, please subscribe or follow the show and share it far and wide with anyone you think might be interested. And just a quick heads up that unfortunately we had some technical issues with this recording, and it glitches out a little bit. Our editors have done everything they can, so hopefully it's not too distracting, but just apologies for that if some parts do cut out. And now here's Marina. Hi, Marina. How you doing? Welcome to the podcast.
Thank you so much for having me. Doing great. Friday. Happy Friday.
Happy Friday. Yeah, it's great to see you as always, and excited to dive into some of the work you've been doing recently around sustainable investing trends for the year and lots more. But for our listeners, why don't you just start by telling us a little bit about Schroders, for those who might not know, just sort of the broad strokes about the firm.
Yeah, absolutely. So Schroders is officially now over $1 trillion US dollar organization. We are the largest listed asset manager in the UK, domiciled in the UK. We're also 200 something years old. So I find it funny sometimes that we're in the US, we're a little bit less recognized despite that size and scale.
Mm-hmm.
And what we are is a pretty much 100% active management. So we have, out of that $1 trillion, about 900 billion is public markets, about 100 billion is actually private markets, private assets, under the umbrella of something called Schroders Capital. And all of the strategies of 60 different investment desks running money from everything from, real estate and private equity and insurance-linked securities to global equities and corporate debt. And everybody is doing it in an active way. So it's all active management, and sustainability is really, big part of what, which of course we'll talk about, a big part of what we do across all 60 asset classes where we manage money. And so, and that's been the case for a couple of decades now. And for me, we have a group of folks who focus on sustainability integration, across our strategies and working with our clients on what they need. And so that we have regional heads, right, who represent each sort of region and what's needed in the region. And so I'm the head for the Americas.
Mm-hmm. Got it. That is super helpful. And yeah, it is funny. I lived in London for a couple of years, and Schroders was just everywhere. It's sort of a household name, but that's great. Thank you. And so you've done, as I said, put out a really interesting paper late last year, early this year, about the trends to look out for in sustainable investing over 2025, identified 8 of those. Obviously, it's been an interesting first few months of the year, so curious to hear what might have changed. But tell us about just like a couple of the highlights from those 8 trends. What are some of the big ones that sort of jumped out as you did that research?
Yeah, I mean, totally. And this is something that I do every year. I just kind of crowdsource and identify what seems to be, kind of on the horizon or developing. And some things carry over from one year to the other because they're sort of developing trends. Mm-hmm. But a couple of things that I would talk about, we struggle collectively as an industry to figure out kind of, the headline is money's coming out of sustainability. But there's a lot of us around that, in the sense that money is moving from public markets, it's moving into private strategies, it's moving into segregated mandates, right, where it's less easy to see it. It may be moving from kind of more, I would say, like last generation product, right, which is just an ESG or sustainably labeled fund, to more thematic strategies that have a specific purpose. And again, it's harder to capture that when some of the third parties are looking at kind of flows in the industry. So I think that's one sort of thing we need to struggle with a little bit, is kind of, where is the demand? What does it look like? And where is money actually flowing, right? So that's one topic. Another one for me, especially in the US, is how do we address climate? Obviously, the world, has sort of moved in different directions in terms of what our European client base is interested in versus the US, right?
Mm-hmm.
But there are still kind of ways to approach this topic, which we know is this broad super trend, right? This very long mega trend for probably decades to come of decarbonization. But how do we approach it from sort of different angles that just make sense? And so for me, one of those angles in Americas, in the US, is looking at physical risk. There's transition risk for companies, but looking at physical risk, which is something quite tactile, like you can see it happening. And thinking about the real financial impacts of that, for example, the cost of insurance or just the insurability of assets, and really come from that perspective, right? Let's assess risk this way in a way that is, again, more accessible for folks. And then the overall kind of, as I said decarbonization. But to me, decarbonization sometimes sounds like something painful, like it's a punishment. I have to decarbonize a portfolio, that's all. But there's the other side of that discussion, which is around, well, if it is a mega trend, right, there's going to be obviously people benefiting from it. And they're the people who are going to be on the front foot and back foot. So how do we talk better about unlocking opportunity from this transition, from this change? I think change is a great sort of word to just keep using, right? Because that's ultimately what sustainability should be seen as, being able to invest in things that will not be hurt or damaged by changes that are coming, but rather be able to thrive in that change, right? So that's how I want to think about climate, is kind of from a more positive angle, and that does seem to fit the zeitgeist in the U.S., where we're talking about energy dominance and energy security and energy pragmatism and but looking at it from the perspective of kind of a more positive approach. How do we become masters of our own destiny in terms of meeting our demand, right? And over time, kind of, having to be a pragmatic approach, and something that works to minimize both the transition and physical risk. That's another area. And that actually kind of folds into what I think of as that sort of thematic approach, right? That rather than having this broad and sometimes opaque and people have trouble understanding what you're talking about, like, oh, something is just sustainable. How do we identify, like, I'm looking at companies that are going to be climate leaders, or I'm looking at companies that benefit from circularity, or I'm like, as a fundamental investor, what is it that you're looking at? And I think that's much easier to talk about than kind of broad-based, like, quote, ESG and being kind of, subject to just the acronyms. That's another trend I talk about, which is kind of looking at themes, right? And really trying to dig one level down from just sustainability overall to what are the themes, whether it's demographic changes, like what is it that you're trying to anchor your investments to? And then one of the kind of, I would say, big themes within that that I also put on the list is nature and biodiversity. And we're early, I think, days still, but there are both risks and dependencies and real opportunities around companies that are they are heavily used, let's say, users of sort of natural resources. And again, from a fundamental investment perspective, that's a really interesting area to explore for opportunity as well as de-risking. So those are kind of the big themes. And then I already said, right, the kind of private assets discussion, which is a lot of money is moving into private markets. We just know that to be the fact in general. And so it definitely behooves us to think about how sustainability and decarbonization and all of those things can be approached, not just in, like, let's say, a public market setting where we sort of know what the tools are, right? You're maybe engaging with companies, proxy voting, right? If you're a public equity investor. But what if you're a real estate investor? What if you're a private equity investor? What if it's infrastructure? What if it's, another area? How are you approaching it there, right? If you're looking to decarbonize across the portfolio. So again, those are some of the big things that I've kind of been focused on, and we try to tie that to research that we're doing and support that we're offering to our clients.
Mm-hmm. Yeah, that's great. Well, let's kind of dive a little deeper into a couple of those. And let's start with the climate impacts and the physical risk. And you mentioned, some of the implications for insurance. I mean, that's something that clearly, regardless of political context or sort of way those political winds might be blowing, the climate impacts are going to be real risks for all kinds of assets and all kinds of companies and supply chains. But as we've seen, with some of the comments coming out of the insurance industry about what they're going to be able to insure in light of this, that seems to have potential broader implications for sort of the whole insurance market and financial system. So tell us a little bit about, how you're thinking about that. Do you see, where you see those implications going and what that kind of looks like in the investment process?
Yeah, absolutely. And so again, it's about sort of risk in our portfolios, but also about opportunities and meeting some of that need effectively, right? So I think at one level, it's just the research that we're doing, with our economics team, kind of broader top down, where we're looking at global climate related insurance losses. And I mean, you can get into, I've done a whole presentation on physical risk, and it can be really pressing, and the numbers get really outsized, especially kind of as you, project outward.
Yeah.
And so I don't want to get kind of stuck in that doom loop, right?
Right.
I think you want to apply it to sort of what does that mean for, let's say, you diversify, or kind of where are you looking for opportunity. But at the end of the day, again, there are, obviously greater costs to this. And I think the insurance industry is reckoning with the kind of where they are both as risk takers, right, but also as investors themselves, right,
Hmm.
because they understand this risk so intimately as investors. I think there's a couple of areas, let's say, for us that we're excited about in terms of insurance, one of which is insurance-linked securities, so catastrophe bonds, right? And this is an area that can take on risk, right, especially in sort of peak areas. And this is something that Schroders has been doing for many, many years. We actually acquired our specialized shop back in 2013 in Zurich. And so we have grown that platform, that sort of insurance-linked securities. And that, I think, can help, kind of address that protection gap, right? When you're referencing, right, if insurers are, leaving certain markets.
Tell
So
us
I
a
think
little
that,
bit about how that works. Like, what is a
yeah.
catastrophe linked bond? How does that work?
Yeah, I mean, so it's basically, I mean, these are instruments that will like take excess risk,
Hmm.
right? And it's a really interesting asset class, and it's been interesting to institutional investors for years because it's very uncorrelated with financial markets. I mean, it really is only correlated with sort of weather events, effectively. I think it is a very seasonal instrument. So this is, I think, sometimes it's hard to tie it to sort of the long-term, kind of climate change shifts, right?
Hmm.
Because every year you're looking at, let's say, tornado risk, or I mean earthquake risk, right? And so again, this is investors basically kind of taking this excess risk, right? I mean, some of this risk is covered obviously by public entities, governments themselves, some of it by private insurance, and so this is a kind of another layer of risk, and so like I said, so it's existed for quite some time, but I think that sort of asset classes also started to think about what is that kind of long term like shift or shape change, right? To what they do and how they have to price that risk and think about that risk and the frequency of events that maybe sometimes were considered once in 100-year events, but they're becoming less so. So how do you sort of approach it? But I think the bottom line is that having another pool of risk takers, right, to sort of diversify that risk is obviously very valuable, right? And so if you can make that sort of profitable, that's really important. Another thing that we think about is obviously places where there hasn't been coverage. I mean, I think there's a lot of, print space given to the places where coverage is being taken away, right, or kind of reconsidered. But there's obviously kind of vast swaths of the world that are just uninsured to begin with.
Hmm.
And the kind of promulgation of insurance in those markets is actually really important because a lot of those are emerging markets and kind of less wealthy economies where a catastrophe really is a catastrophe for people, for communities. And so that aspect of kind of adapting, to climate change and adapting and being resilient, right? Building kind of financial resilience is really important. And there's been a lot of great innovation in that space in terms of insurance technology, insure tech, right? Early detection, early warning, parametric insurance, which is a type of insurance that you can sell where, just based on a certain sort of degree of event, right, you pay out rather than somebody having to submit claims.
Mm.
And so that the extension of that kind of insurance to smallhold farmers, et cetera, across emerging markets and kind of developing economies is really important. And then in a couple of weeks, I'm actually going to be at an event in Montreal, and we're speaking on a panel around the insurance industry sort of response to these things. And the next stage, I think, of discussion is actually beyond just the catastrophe risk, and also crop risk is another one that we look at, right, in these emerging market economies, is, crop destruction,
Hmm.
but it's actually human health risk. And I'm a big fan of sort of contextualizing everything in terms of how it affects people, because I think that that's how we can come to sort of an understanding, right? That these things are not theoretical risks, but they're actually really impactful to individuals and communities and like populations. And so it's all about the human. And so the human, there's this physical risks that are very related to, again, climate disasters, so respiratory disease, infectious disease, airborne, right, disease,
Hmm.
waterborne disease. And then I mean, we hadn't even thought about it really, although we are now. But sort of mental health risk as well,
Mm.
not just physical, but mental
Yeah.
health risk, and how it impacts again when you have these large scale disasters. So we had two funds that we've raised already on the private equity side on the impact front that were around insurance And again, it was crop insurance and kind of catastrophic insurance. And then the third fundraise is actually going to include some crop insurance because, you're seeing that develop. So again, I think it's bringing investor capital to those areas where there's clearly going to be sort of more need. And, I guess the equation has to work, right? Because it also has to be lucrative for the investor. But I think that's where folks are, again, sort of competing, right, to develop, what are these approaches that we can take to address some of these issues. And that's what I mean about this kind of, you're on a mega trend. You have the luxury of sort of seeing it happen, right? So it doesn't sneak up on you like some other things sneak up on us as investors. So how do you then develop, right, from a kind of a portfolio standpoint, some durability, some resilience to that, and how do you, take advantage of some of those trends?
Yeah, got it. So that's interesting, and it's like we said, those physical risks are coming, and there's ways to address those risks and look at resilience and adaptation. But on some level, we know we need to have kind of stronger policy and address this sort of systemic risks at a big picture. And that was one of the other trends you identified as a growing call for policy leadership. And as you said, that can look different in different parts of the world. But what do you see as kind of the policy shifts that really need to happen? And how do you see investors, playing a role in that and sort of shaping those public-private partnerships around some of these sustainability policies?
Yeah, I mean, it's a tough time to obviously, given everything in the news, right? So be talking about this. It feels different sometimes. But I think, again, we need to sort of look past the big bold headline and recognize that actually there is a lot of consistency building. You have a lot of the voluntary disclosure, not a lot, but the voluntary disclosure sort of regimes, the kind of ISSB, IFRS 1 and 2, I mean, being adopted either as mandatory, frankly, in many markets. We've been advocates, right? When we see that being considered by a particular economy, we advocate for that sort of, yes, we as investors want to see concise and decision useful information. And this is why we make a case for it being valuable to investors. So I think disclosure is kind of one piece of it.
In terms of companies disclosing their data about what they're doing.
Exactly, right. So that, and I think we've seen obviously in the US from a trend perspective, at the federal level, right, less so, but you see at a state level, I mean, California, but now other states as well, sort of saying we don't want to be left behind in this regard. And this is kind of what is appropriate in terms of companies, again, sharing material information about themselves that investors can understand it. I think in terms of policy direction, again, it can be difficult sometimes. We look at the kind of omnibus, and I'm less of an expert, obviously, on the European side, but I think that we have, again, been supportive in a sense of the more pragmatic approach, right, to what is the kind of what is the demand, right, of companies, and then obviously of asset managers as well, because we're reporting to our clients, right, and the kind of direction of the setting of policy, right, balancing both the need to address this mega trend of decarbonization, for example, and climate shift, with being economically competitive, right, which every economy is focused on. And I think a large part of that, as I said, is the kind of transition story, right? It's not just the constraining of things, right, creating constraints. It is basically creating an environment where you want to pursue some of those things that can be lucrative solutions, right? So I think there's this kind of the penalty side, but there's the incentive side as well. And so we have an ongoing dialogue with policymakers, certainly in the UK, which is our home market, in Europe. It's a bit harder, again, in the Americas to kind of have that constructive discussion at the moment. But, we put out at least kind of our sort of, conversations around everything, whether it's sort of, the deforestation, legislation, right? How do you sort of approach that, again, with a balance of your mitigating risk, that you're not creating undue burden. Certainly things like human rights. Because it's not just climate, right? It's all of these sort of components. But certainly, again, on the climate side, having, nationally determined, right, sort of objectives, right, and creating an environment where you have, again, the incentive structure developed the right way for the private sector to be able to put money into what we want, like, those solutions we want to be funded.
Right.
I think we can't rely entirely, like I said, on the private sector to sort of allocate itself. in the sense
Hmm.
of like, people have to think about short-term returns too. A lot of investors are very sensitive. And so it's rare that you find somebody with that, on the private side, right? Like such a long-term mindset, right? Where they can really build. And one great example of that I would say is the kind of hyperscaler, like the big companies, right, that are investing in nuclear technology, and they have the kind of the bandwidth, right, to sort of make those very long-term investments. But those are kind of not isolated examples, but that's an outside sort of example, right? I think for most investors, you have to create the playing field. And so I think, like I said, without getting very specific on kind of what, let's say, we're advocating for in different markets, I think it's that
Hmm.
kind of call to policymakers to say that you have to. We understand why there's been this sort of rationalization or kind of like reassessment of what is, pragmatic and competitive, right, in an environment, especially where, the economies have slowed down, right, inflation's higher, and so just kind of more challenging. But that it's important to keep that moving forward. So we, have looked, unfortunately, at kind of, you know, like ambitions and how that's stalled in recent years. So things like global pledges and targets,
Hmm.
global policies and actions, new climate policies and laws. Those things have come down in recent years. And I think it's important, again, for the private sector to advocate for a focus on these areas, again, a pragmatic focus on these areas, but not to let these things sort of, to go, like not to kick the can down the road. Because again, we're facing ultimately like the direction of travel is very clear. The pace of travel obviously changes based on the sort of, the commitments around regulation, policy, the kind of, what is our political will to do some of these things. And so I
Yeah.
think for investors and in general, like for voters, right, to send the message to policymakers that we still have to think about these long-term issues, even as some of the, kind of short-term issues we're seeing now, it's tariffs and trade and so forth, take up a lot of our brain space. We can't let these things go.
Yeah. No, it's a great point, and I do think I mean, I'd love to see more investor voices because we've certainly seen investors influence policy when there's short-term incentives, and I'd love to see more of that for some of these long-term risks because,
Yeah.
yeah, it's the same. These companies are planning to be around a long time. They're gonna need these policies to ensure a strong, thriving economy. Let's talk a little bit more about the positive side that you've been mentioning in terms of just opportunities for investing in climate solutions. And yeah, I mean, what is sort of looking at? What do you see maybe both on the public and or private side, and how does that show up in different asset classes when you're looking at just sort of those solutions, those companies, those technologies
Yeah.
that are going to develop that low carbon economy?
Yeah. So I mean, like I said, we kind of all know like some of the technologies in particular. I don't want to get into like so it's like battery storage or hydrogen or whatever. And again, I'm
Yep.
not like I'm not an analyst. I'm not covering individual names, but I think it's the broader like. So I'll bucket it out for you. When we think about climate, we think about three categories. One which is kind of a low carbon investments, right? One of which is what we call climate action. I think people have
Hmm.
been using the word transition a lot, but it's the same. That's the same category. The kind of climate action companies are taking action over time, and then there's the solutions piece. And I want to make sure that we cover all of those and not just like the one solutions bucket.
Hmm.
Solutions, you obviously have again the kind of goods and services that can help that transition happen, that kind of climate transition happen or decarbonization take place. The challenge is a lot of those things are still small scale, which is, of course, why you have to sort of be in private markets where a lot of the early funding for some of this technology takes place. Some of these things, are like, I think the returns pattern is quite erratic and can be challenging for an institutional investor. But there's definitely a place for it. And again, we think about it in like all areas. So on the like the nature side, as an example, there's companies that we're looking at from a circularity perspective, like things like recycling services and reusable packaging and pollution prevention and sustainable use of water, right? Water treatment and aquaculture, right? So again, I mean, some of this is at small scale, but you have to build it over time. And then on the climate side, certainly on kind of the private side, we work very hard to be able to kind of think through again, like how do you identify this? Not just like how I could have decarbonized the existing portfolio, but where do I search for solutions? And so, for that Schroders capital business that I mentioned, that's sort of $100 billion of sort of the private side, some of the things that we're looking at is around mitigation, right? So climate mitigation and adaptation. And then, within that, is it again sort of uh, like what is like the nature of the kind of actions these companies are taking? As an example, you have kind of on the just examining climate solutions exposure, right? Could be like waste treatment, could be around kind of manufacturing and production, right, across sort of different sectors. So even in larger companies, I would say, right, are sort of like creating new business lines around some of these areas. And so again, we have a whole kind of dedicated effort, in kind of looking at some of those, some of the solutions. But I do want to bring in when people sort of say climate solutions, I don't want to leave aside that sort of climate action area. Mm-hmm. And so we also think about the amount of sort of value that you can unlock, actual returns, and then also the amount of benefit that you can produce in terms of actual, not just portfolio decarbonization, but real economy decarbonization from that climate action category, that transition category, which, may start with companies, again, very broad, diversified across all sectors and industries that don't look particularly great from a kind of a green perspective, right? Mm-hmm. But that's really where you want a lot of your effort to go in terms of, putting money towards their evolution, engaging with them actively and unlocking that potential. And we have good data now that, we look at that sort of indicates that, again, both from a return standpoint, that is the most lucrative bucket, that the market over time begins to reward companies for themselves, their own operations becoming less carbon intensive over time, because they are lowering their own risk, their own costs, and they're creating a positive network effect for themselves, right, as supply chain participants to other companies. And then, in terms of, again, like the actual level of decarbonization, because the low carbon bucket is already low carbon, right? But this bucket actually can be quite high carbon. And so it's the kind of evolution of that over time to a better, position is where, you can really see that impact. So
yeah. And just to reiterate, like on a really, yeah. And just to reiterate on a really basic level, you're talking about companies that aren't focused on driving climate solutions, but they're just manufacturing or they're just doing whatever business they do. And it's shifting to renewable energy. It's becoming more energy efficient. It's lowering their own carbon footprint so that the whole economy is decarbonizing. And as investors, you do that. You do that by engaging with them and, just encouraging them, showing them the benefits of doing all that and letting them know as investors, you want to see that happen.
Real estate is another massive area for this, right? And sort of allowing, for decarbonization in terms of sort of buildings, right? So it's not just the new building construction, but retrofitting existing buildings. What is their energy use, right? So kind of like embodied carbon use, all of those things. I think we have, big sort of property real estate practice, and they're very forward thinking, that whole industry about, and then there's obviously a lot of carbon, emission is sort of in that space. Infrastructure as well. So again, it's not just companies and kind of buying their equity. It's thinking about all the kind of places where, again, you have that kind of existing, who's really contributing to carbon emissions, and where can you sort of work through that? And obviously the oil and gas companies, right? Like you would be remiss not to say it too, right? That we have a traditional energy practice, renewable energy sort of investment practice. We do a hybrid approach of those. But even if you're thinking about kind of alternative energy, or you're thinking about what the future looks like for renewables, it's definitely not outside of the sort of big majors. Because a lot of the, again, kind of the future for those companies and the investments that they're making over time are leading in that direction too. And so as an active investor, you want to be an advocate for that, in a way, obviously, that's going to, to make sense for them from a profitability standpoint.
And tell us a little bit about this. You're kind of speaking about, you mentioned the returns and the financial benefits of some of these approaches, and Schroders just partnered with Oxford on a new paper called Impact as a Source of Alpha, the elephant in the room. Tell us a little bit about that, what the findings were, sort of, again, what asset classes that was looking at.
So I want to be careful with this one. I love that you brought it up. Thank you. But I do want to be careful because it is impact. And so it is a more narrow sliver, right, of kind of what we do. And I think, again, we sometimes in the industry do ourselves a bit of a disservice where we don't sort of pause and kind of define these things, right? So when I was talking kind of more broadly on the climate side, we're talking about just in general, right, where you invest in companies, which this is kind of like, let's say, large scale equity investing, right?
Hmm.
Or on the real estate side or somewhere else, right? You're investing in companies or in assets again that are going to be able to thrive in change, right? And so the market over time will reward them for it. On the impact side, it's really interesting because there's been this received wisdom that investing in an impact approach, right, is always going to be concessionary or is always going to cost you returns. I mean, again, I want to be very clear that impact is a very small part of what we do. We're excited to see it growing, but out of $1 trillion, the Schroders about $5 billion is really impact investment. We think of impact as something very rigorous, where we really have to make sure that, how do you prove, right, that there's the company itself is making an impact, right, with what they do, what the kind of the goods and services they're producing, that you can measure who they're impacting, and how much, right? So the kind of measurability element, and that you as an investor are also having additional impact, right? That the company is going to have more impact because of your money, specifically your money, right? So again, it's a very high hurdle. But I think what's exciting about what we did with, again, so this is like, we defend all the time the issue of sort of integrating sustainability, where somebody says, does that decrease returns? And you're trying to, in a very full-throated way, say no, right? If you are doing a better job of looking at risks and identifying opportunities, and you're not sort of unduly constraining yourself, right? So it's not like just exclusions, right? It's this kind of opportunity seeking and again, de-risking and engagement. You should over time actually create more returns. That's our defense of kind of the broader sustainability space. But for impact specifically, sometimes you kind of concede, right? Because it's hard to argue sometimes, like, is it really going to make money? So this is actually a really great sort of opportunity to kind of move that conversation. That even in this particular space, where it is really, like I said, very rigorously sort of driven impact, it's not the story that people sort of maybe thought it was. And so what we did, this is for listed markets impact, which was an easier area to kind of assess because, the data is there. And we looked at nearly, I think it's 270 companies that we invest in across our impact portfolios. We looked back a decade. We definitely did, kind of like, we don't want to just be like rewarding the winners in a sense, right? So there was a lot of work that we did to kind of clean through that back test. But in effect, trying to assess whether these companies, given different market cycles and market drivers, again, you're trying to sort of account for those things, are they performing? And so what we found is that we actually evidenced that impact can be a source of alpha. Again, drawing from hundreds of firms, a decade of performance. And what was really interesting is that impact materiality, right? So the way we sort of think about, the extent to which a company's revenues derive from products or services that deliver measurably positive impact was a key factor in performance. So in other words, firms that had a higher impact materiality tend to exhibit stronger financial performance, so that we're seeing a statistically significant relationship between impact materiality and excess return. So let me just sort of say a little bit more on this, right? So, we were looking at how impact-driven businesses have certain characteristics that actually contributed to their financial strength. So we found that impact-driven businesses had higher operating margins. They had stronger workforce growth. They were more focused on reinvestment. I mean, so these are just kind of prudent, right? Like these are just kind of well-run businesses. And so we found that, again, these impactful companies could deliver competitive financial performance. And not only did they have higher risk-adjusted returns, but they actually had lower volatility. They had lower resilience across market cycles. And we were looking, again, at total returns, risk-adjusted returns. We were looking at kind of these fundamental drivers. And so, again, we were really trying to isolate this kind of, impact alignment. Can it be a source of alpha rather than a constraint on performance? So the research is available, right? If folks can now access it. It's on our website, along with Oxford. And then, we look at it across our existing portfolios in terms of how we approach in public markets, again, listed markets, impact, that our equity investors are starting with very fundamental premises, right? They're looking for really healthy companies that are doing the things that I've articulated, right, this company is doing in terms of, their approach to their business. And then, you are able to find, again, these really successful companies that are addressing real challenges because those challenges are very real. Obviously, they're finding customers and they're drawing employees, right? And they're reinvesting in themselves. They're finding great opportunities for lucrative reinvestment. So I think it's exciting.
Yeah.
And again, it's not going to be like the final answer for everything, but I think it just gives us another sort of, arrow in the quiver to say, don't accept the sort of received wisdom or the kind of negativity, like actually examine, right, what is possible. By itself, I would say listed assets impact is still an area of skepticism for some folks. And so
Right.
even that, I think, is a good contribution.
Yeah, well, it's interesting. I mean, it's great. It's great to have that research, and it's interesting. I appreciate the definition or how you think about impact because, there are varying ways that people think about it. And, I think we all say in the industry, all investing has impact. So on that level, there's sort of like, how do you think about the impact? And then, as you just said, people have different perspectives on how public equities investors can have impact. But it's interesting, you mentioned sort of the additionality of like that higher bar for impact and thinking about it. And it almost seems like a little ironic, though, if you find that the financial performance is better, then is it additional? Like wouldn't all investors who can see that benefit invest and have that positive impact just because it's better business for all the reasons you just laid out? It's a slippery definition, I think, of impact, and just the additionality in general can be tricky when you start to see that
Yeah.
the performance is there and it's not concessionary, because some people think about impact investing as like having to be concessionary and define it that way, and of course this all creates a lot of confusion in the field as we talk about it.
Yeah, but my point is, right, this is a back test, and so
Yeah.
it's like it's an optimal situation. The reality is you have to find these companies, you have to
Right.
identify them, and obviously not all of them succeeded. So I think it comes to, I hate to say it, but it sort of also feeds into active management. It feeds into
Yeah.
this kind of fundamental analysis that it's not like you're going to find some easy index play.
Right.
And it's just going to work. I mean, there's real, like I said, there's real effort that needs to be undertaken to find, as in any, fundamental investing, but to kind of specifically find the companies that are performing this exercise in
Exactly.
the
Yeah.
best way.
I think that's such a fundamental point because we always get this question: does sustainable investing underperform or outperform? And it depends on the investor, just like any other type of strategy. Some people can try to do it really well, and some people can try to do it and not do it so well. But it does give good
listen,
investors more info to go on.
absolutely. And I think, but if it's a passive approach, I think that question of, is sustainable going to perform better or worse? I think it's really important, again, even there to define. If you are by default saying low carbon,
Yeah.
right, is the thing, then absolutely will underperform some of the time, like
Some of the
anything
time.
else would, right, that has a specific, right, kind of theme or, like I said, is tailored in a certain way. Like we go through market cycles. Everybody obviously should be
Right.
well aware of that. So, but then you think about the long term, right? What is the time horizon over which you're considering this? And that obviously changes many things
Exactly.
in the
Yeah.
consideration. So,
Yeah, and there's a great piece of data research that Jeremy Grantham did a few years ago, looking at taking any sector out of a portfolio over a 50-year time period and it making no difference to performance. So it's all about that time horizon that you talked about. But yeah, I think it's a really important point to distinguish passive versus active strategies, and just this whole, you can't really boil it down to a simple question to do these strategies underperform or outperform, because it depends on a lot of things. Let's just quickly move along here to private markets a bit, because we're talking about public markets, but I know you also have done, you mentioned the segment of Schroders work in private markets, and you've done some research around this in terms of decarbonization. And just tell us a little bit about the opportunities there, how it's different than public markets, and how Schroders thinks about that.
So the research was more focused, I would say, on kind of like measurement, right? And kind of what is the, like what are the targets that somebody would set? What kind of metrics are available? So it's understanding the differences, I would say, in carbon metrics reported across private assets. Targeting setting approaches for decarbonization and portfolio alignment. And then what are the decarbonization levers that you have available to you in private markets? Again, you're not voting proxies, you are engaging certainly, but in a different way than you do on the public side. And we have done, even before this research, we do an engagement blueprint document for private assets, where we've asked all of our kind of investors across, again, private equity, private debt, securitized, real estate, infrastructure, to give us what they feel is the kind of best practices for how they engage, right? So, for example, in real estate, obviously you're engaging with the building owner, the building tenants, right? Like, what does the engagement look like? How are you sort of driving decisions forward, to address decarbonization? So, and then, engaging with privates to encourage emissions reporting. Obviously, that's the kind of key first stage in assessing decarbonization. So a lot of what we wrote about was kind of that, trying to create some consistency, right, around data. And again, we're not the only ones obviously working on that space. What I think is interesting is how private assets sort of intersect with sustainability across sort of different, different asset classes. And in terms of the opportunities that are available. And this was a little bit less in the paper, but it's certainly things that we think about again in that Schroders capital business. So for example, on the private equity side, everything from technological revolution to kind of adopting more sustainable lifestyles and, the need to decarbonize and address climate change and these long-term trends. I mean, all of that, I think, favors sustainability and impact. And in private equity, you can access obviously a lot of the companies you can't find in the public markets at an earlier stage as well. So again, if you're an investor and you're looking to have that, you said impact with that effect, right? And you're looking for the kind of opportunities, this is obviously a critical area. In real estate, which I mentioned is such an important space for decarbonization in the real economy overall, it's that kind of operational excellence, right? In terms of existing buildings, Schroders owns about 700 sort of buildings across Europe, for example, and so each of those buildings is an investment onto itself. When we think about sustainability for that building, and also resilience and kind of adaptation, right, for that building in the context of the city it's located in or the area, and what might happen there, again, from a physical risk standpoint. And then again, kind of how you, over time, make that asset attractive and competitive, right? So that tenants want to be there and to pay, to be in the space. So a lot of, again, like lots of, very key, I think, long-term value from real estate investments, a constantly evolving market. And so, but also a place, again, where we really have to think about sustainability and energy, certainly.
Yeah.
Infrastructure, right? Enabling energy transition, providing essential services. I mean, like this is, it doesn't work without like the pipes, basically. And so those infrastructure projects, and Schroders has a brand called Green Coat, which is sustainable infrastructure for largely energy for wind and solar. And so those projects, again, are going to be really core to, the growth and prosperity of economies. And so that's an area, obviously, for investors to participate in. And then finally, private debt, credit alternatives. You have everything from microfinance, again, funding sustainable infrastructure, natural capital, right? We said it's a more nascent area. Mm-hmm. I mean, like catastrophe and pandemic protection, right? Those kind of more like resilience investments, like lots of really interesting opportunity, including in kind of a blended finance approach where you're kind of co-investing alongside, public monies. So, right. I mean, we wouldn't want to not have this, right? As an investment house, right? There's really exciting areas to sort of pursue, both from a return standpoint, certainly, mm-hmm. but also from kind of moving the needle on decarbonization standpoint across all of these areas that are really complementary to what can be done, obviously, in the public markets.
Yeah, that's great. No, I mean, so much opportunity, as you say. And I love how you bring it back to real estate, too, because that is, what is it, 40% of the emissions in most markets. It's just a huge chunk and, just real tangible opportunity for quick decarbonization. Well, this is great. And I'm realizing, Marina, too, it's just great that you all have this research, which has kind of been guiding our conversation. But for folks listening, we will, as you said, a lot of this is publicly available on the website. So we'll put that in the show notes so people can kind of dive into a lot of this more deeply. And I know there's a bunch of other themes that we didn't cover. We're not going to have time to cover everything, but you mentioned some of them: nature and biodiversity, health, food, circular economy, social well-being. So yeah, I don't know, just before we kind of move on to the final questions, any of those that you want to just highlight for folks?
Yeah, I don't want it to be like overwhelming. I think what I would just sort of say to folks, right, if you want like maybe the framing mechanism, right, is that there are these sustainability mega trends, and that is around resource security. And that's sort of, energy transition. It's the circular economy. It's around healthy living, right? So, it's around the aging of populations, right? Just demographic change. So George, you know this about me, right? I've been in the sustainability space properly for about 3.5, almost 4 years, but I was an investor for many years before that in kind of various asset classes. And so I always come with an investment hat, right? And not necessarily a policy hat to start with or kind of sustainability hat to begin with. I come from like the investment hat, right? Thinks about, oh, wow, like these massive trends, right? Around kind of aging populations, wealthier, urbanized populations. What are they going to need, right? In terms of, certainly energy use, right? In different sort of, again, urban areas, right? As people become kind of more concentrated. I mean, it's just trite at this point, but like the use of AI, right, and the kind of energy suck that becomes. Like we have to create the solutions for this. And so, an investor, like your eyes light up, right, because you again are able to identify a future, and you're able to sort of say, okay, like this is where these opportunities may come. And again, it can be fits and starts. It can be a little bit kind of frustrating sometimes because the kind of pace of change, could be affected by, again, things like political will and things that we don't have as much control over. But the direction of travel is very clear. And so that's what I would say. Like a lot of what I write about is just going back to that sort of basic premise that these are investments. And it's all about the change that comes in the world. And even if somebody's super skeptical about ESG as an acronym, that same person is going to be hard pressed to say that some of that change won't be social and environmental in nature. It will be, right? I mean, that's what investors, when we look kind of further out at kind of some of the biggest, we looked at like the World Economic Forum, global risk perception. So today, people like on the 2-year horizon are very, focused on things like state-based armed conflicts that are taking place, right?
Mm-hmm.
And economic disruption and misinformation. And like there's lots of things to worry about in the day-to-day. But once you look 10 years out, it becomes pretty clear that the big things are like extreme weather events and critical changes to the Earth's systems and natural resource shortages and, ecosystem collapses and sort of, like that stuff trumps a lot of that stuff trumps a lot of the sort of like the shorter term things, right, that we worry about when we wake up in the morning. So I think that's what we have to anchor to as investors. We have to say, these are the big things. How are we going to keep growing? The population going to grow and become kind of more demanding, right, because it's older and we're wealthy. How are we going to address, again, labor shortages, migrations, natural resource use, right? We're already sort of overusing. How are we going to kind of build, again, resilience in that regard? And that's, I think, so everything starts with that. And then I think you assess, like, each like investment, I guess, in a sense, like from that lens. So that's what I talk about in my sort of trends, right? Circularity, I think, can be a really massive trend in terms of addressing some of these issues. So that's what I'm trying to do. I mean, I think about it on a year basis because you want to see kind of like I said, this question of like physical risk focus or trying to shift the perspective from like the constraints of decarbonization to unlocking value from transition. I actually think that is the year 2025 is where we sort of talk about it differently because we kind of have to. That's the zeitgeist. But a lot of it is about long-term, I think, kind of future-proofing.
Right. You've got to do both, and you've got to look at what the short-term realities are. But I couldn't agree more. That long-term vision about where we're heading and just understanding the science of the system of, human population on Earth. And we had an episode a few weeks ago with Karl-Heinrich Robert, who's founded the Natural Step, talking about the framework for strategic sustainable development, which is designed to do just that. And it doesn't tell you exactly how to get there, as you say, because it's the system's so complex, but it gives you that sort of North Star beacon that, if we're to not have total breakdown of, ecological systems and social systems, then we know these are the things we're going to have to do over time. So it gives that kind of direction of travel, as you say. All right, Marina, I know we need to let you go, but I've got a few kind of rapid fire questions that are just a little more fun and then a couple of final ones. So what is one book, podcast, article, resource that you'd recommend to folks that are interested in these topics?
Your definition of fun, man, right? I mean, I read a lot of sell-side stuff. We're British, so we like the FT, so kind of moral money and these kind of sustainable views, right? All those things. That's kind of the stuff that I wake up and look at every morning. And then there's a number of really great sort of sell-side, teams, right? They're writing really good research. I'll call out, a couple of Citi and Jeffries. There's really good resources.
Yeah, that Jeffries material is good, and Moral Money from Financial Times. Good ones. Do you have a sustainability hero or a person or organization that you really look to as inspiring on these topics?
I'll go back. I really do like the Jeffries approach because it's, like I said, it's very grounded in sort of investment fundamentals to me. And so it's very pragmatic and it kind of just speaks my language, I would say. So they're like the way that they've approached sustainability, energy transition, all those topics really make sense to me.
Awesome. All right. So climate and other sustainability challenges can be scary and overwhelming, as we've talked a little bit in our conversation already. Do you have any tips or strategies that help you sort of stay grounded and positive that others might learn from?
I mean, again, it just seems very trite, but I think we can't underestimate the power of human ingenuity. Like we,
Yeah.
we're we thrive as a race because we sort of come up with solutions ultimately. And sometimes it feels like, oh man, like you're never, but like just look at the path of human history, right? So I think, yeah, we just have to, and everything, like, if something is uncomfortable at the moment, it doesn't mean it isn't going to change going forward. Like, that's the one constant too, is change. And I don't
Hmm.
like not to get political, right? But I think I think you just have to have that North Star, right? Which we talked about, know why you're here. I mean, we're investors, right? For institutional clients. So it's really important for us to articulate what we're doing, which is we are always looking at creating like prosperity for our clients. And one of the main things we can do to create their prosperity long term, I'm sure it's going to have 200 years. We hope to be around for another 200, right? Like we can create prosperity for them by being forward looking about their portfolios and where there's risk and where there's opportunity. And that's it. Like everything goes through that prism. And so some of it, yes, some of it is sustainability focused, some of it is not, right? But as long as you, again, you have your North Star and you just recognize that, like, I know I spent time as a value investor, like things come in cycles. Like, and if it's an uncomfortable moment of the cycle for you at the moment, it doesn't mean that it's always going to be.
Yeah, absolutely. And yeah, I mean, the innovation piece is just huge, and that's always exciting. And that's what the sort of constraints of sustainability can help drive too. It can really be an
Yeah.
innovation driver and get
Yeah.
people to think differently. Okay, so we talked about a lot of the themes in focus. What's a sustainability theme that you just think is overhyped and that, we shouldn't maybe be too
Yeah.
focused on?
I'm going to not punt a little bit, but the thing that frustrates me and has always frustrated me the most is when people, I think it's very natural, just edge into politics or like othering. You know what I mean? Like where you gather at a sustainability conference and this is sort of like it's us in the room, but then there's the other people who are not in the room and they're the problem.
Right.
You know what I mean? And sometimes it's like these companies are good, but these companies are a problem, or like these people just don't get it. And I just think you create so much more division that way than if your mindset is about, I always say, respect and empathy. Like,
Hmm.
let's just be empathetic. Let's be respectful. Change is hard. Change stinks sometimes, right? So we're all here together. Let's think about how we approach it. We just published a toolkit on just resilience, which is
Hmm.
like just transition, but it's a bit more, right? And it looks at what climate like changes and kind of weather related risk, but it looks at it through the prism of workers, right? The impact on workers, right? Health and safety, etc. Like everybody's got a different, like a slightly different lens, a slightly different purpose. There's different ways you can talk to somebody, right? Where they say, well, like climate change doesn't, concern me. But actually here it does, right?
Right.
Like through like the prism of how workers are impacted, right? By heat stress or by whatever, like just find the common ground, right? Because
Yeah.
I think people will just default to like I said, to the negative. And I would rather that we focus on the positive.
It's a great point because
Find
this
the
is
common ground.
one issue that obviously involves everybody and is for the benefit of everybody. And I do think sometimes it's just the language we use to talk about it. But as you say, there's different ways to talk about getting to the same end because I think we all want humanity to continue to thrive. So hopefully that's a common goal we can all get behind in some way, shape, or form. Okay, so forgetting about work altogether for a minute, what are some of the favorite things that you like to do when you're not investing?
Yeah, I mean, this is a question for a parent who's got like preteen and teen children. Is like obviously like, yeah, I mean, that's it. I'm kind of very active in their lives. We love to travel with our kids. We love to experience things with our kids. Actually, my kids are coming this weekend I'm presenting on sustainability. So it's one of the few times it
Oh,
crosses
nice.
over. It's going to come and kind of listen to mom present. But that's it. I just have, kind of not growing because I only have two kids, but, the kids, right? Our family. And so that's really my focus the rest of the time.
Yep. Beautiful. I love it.
Um,
Well, Marina, a couple final questions that we ask
yeah,
all of our
yeah.
guests. So, given all of this, kind of just on that big picture, what is your vision for the future of finance, and what do you think needs to happen to make that a reality?
Just define for me like the future of finance, not just the podcast, right? It's like the overall future of
The whole
finance. Or,
sector. What does the economic system
yeah,
need to do? What's the financial services system need to look like if we're going to be
yeah,
successful in this?
exactly. So I think that, and I actually spoke to one of our economists about sort of doing a piece on this. It is very challenging when you have this dichotomy or this sort of false narrative built about a dichotomy between either we can do the right thing, in terms of making ourselves more durable, right, more sustainable, lowercase s over time, or we can be profitable. That it's really, really damaging, right? And that's at the kind of the sovereign level, right? So kind of like sovereign policy, and then it's obviously kind of at the markets level. I think people just need to myth bust on this, right? And I think a lot of it is, as you said, it's around time horizons. But I think we just need to find a better way to get more people under the umbrella, or like under the what is the tent, like, right, the circus tent, everybody in, that they're not, you can't create two poles. There aren't sort of two separate things, where on one hand you're profitable, and on the other hand you create that durability. That the only way long term that you're going to be profitable is through that durability. And again, that sort of resilience to change, and not just resilience, but like, how do you thrive?
Hmm.
How do we thrive in the environment of change? And then let's talk about change, right? Because I think that that's where you can find some commonality in terms of what people can see the direction of travel being. Again, the pace varies, but like, what can we agree on as kind of the big, broad themes in terms of change, and then what do we need to do around those? And I know it's easy to think long, like short term, right? But this is where we talk about kind of the need for policy to create those longer term incentives
Yeah.
to orient the investor mind kind of further out. Right, so you're not constantly having to defend yourself on a quarter-to-quarter performance basis. So that I think is the kind of where we need that feature of sort of having a more long-term mindset, and recognizing that there's not sort of two variants. There's only one.
It's only one.
We have to bring together, and that's how we succeed.
Yep, love it. All right, final question here. The other way we think about the future of finance is those young people who are going to be the future of finance. What kind of advice would you give them for anyone interested in the field?
Yeah, I mean, this one is really easy, which is you have to start with finance. I know there's a huge discipline now in sort of sustainable finance, and very like actually some narrow areas of study. But I think honestly, I think if you're not a markets junkie to start with, like if you don't sort of build yourself up that way, I think it is very hard to not, to really make that contribution, that sort of full contribution. And I think we've grown very quickly in recent years. So people have been attracted into the industry through sort of different, kind of non-traditional paths, which is great. But I think once you land, you have to make sure that you understand the markets. It's very different if you're going to work in some other facet of sustainability, right? So if you're working in corporate sustainability, or again, policy making, or not policy making, but like think tank, like there's different areas, right? But if people say to me, but I want to be in finance, it's sustainable finance. Okay, great. Let's start with finance.
Yeah.
I think that you have to really build yourself that foundation, because we're not saying like, again, we believe in sustainability because X, Y, Z. What we are focused on is long-term returns, right? And then because we're focused on long-term returns, we have to, be very conscious of all of these different factors to include sustainability factors. But that kind of long-term focus on returns, whatever asset classes you choose to work in, has to come from the understanding of the markets.
Yeah, that's something we've heard quite a bit. Just like more tangibly, what do you think? Say you're a college student. Is it internships? Is it coursework? Is it thinking about an MBA after school? Is it thinking about landing with a firm to get your CFA? What kind of specifically did?
I mean, I
all
have
of the
to
above?
imagine that. Yeah, I think all of the above can work, right? I mean, I think certainly my personal route, right, was I did consulting, and then investment, and then I went to business school, and then I came out I did investment banking. I think I know people who have done incredibly well without that sort of graduate, degree, sort of taking a break, or sometimes, I mean, the amazing people do it concurrently, right, where they sort of study for a graduate degree while they're working, which is unbelievable. I think the CFA route, I'm speaking at a CFA event next week, so I certainly want to plug the CFA folks, right? That's a really rigorous examination. The CFA, by the way, now offers obviously, coursework around sustainability as well. But I think whatever it is that you do, I think it's just that kind of really leaning in, like just expecting it to be a lot of effort, to like work really, really hard, especially in the early years. You just want to, I don't know, like maybe it's not in vogue to say, you just want to hustle like really hard in the beginning, so that you put the time in to build that expertise. And as I said, I think that's a kind of basic markets expertise first. That can be academic as well. Like I think the university should be, mindful of kind of putting out graduates who have that broader, right, understanding. A lot of it you learn on desk, like once you start working, and then obviously you start to sort of specialize again, whether it's, fixed income focused, right? You could be, whatever it is. Like people build like really significant expertise, and if the interest obviously is in sustainability, you will find, right, a real need for that sort of that specialized expertise across all of these areas, right? Once you've built yourself that foundation.
Yeah, perfect. Well, Marina, thank you so much. I know we got to let you go, but always a pleasure. And thanks for sharing your work. And I look forward to talking again soon.
My pleasure always. Thank you.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.